Hi, everyone. Welcome to another episode of The First 100 Days. Joining us today are Brian Murray and Ethan Ruby, both partners at Craft Ventures and have worked together for more than 5 years. Together, their operating experience covers product, sales, customer success, and operations. Brian is also a co-founder of Cabal, a tool that helps founders get more from their investors and advisors. And Ethan is the creator of SaaSgrid, a tool to help companies track their KPI, keep businesses on track, and helping them raise follow-up funding. So in this season, we discuss all aspects of revenue alignment. And alignment comes first from having the same goals and metrics, especially now during a downturn. So the term efficient growth is on top of every revenue leader's mind right now. What does that mean, and what is considered good in 2022?
I think what's good in 2022 is what's always been good for business, right? Like if you really go back to the fundamentals, the point of business is to sell, valuable products and services and, get really good return on their investment. Put in a dollar, get multiple dollars of revenue out, ultimately like create profit that can be shared between shareholders and employees, etc. And, those are like what you would call business fundamentals. And, I think that's what investors and in general what's good now, right? People want to see businesses that have really good efficiency, that can invest in sales and marketing very profitably and then, continue to sell their products, with high gross margins. But to Brian's point, I think the real anomaly was that, kind of in 2021, due to a whole bunch of factors that I think everyone's well familiar with, we kind of got away from that. It's not that the things stopped mattering, it's that people started focusing so much on the extreme leading indicators of growth. But it's not just growth that matters. It's, running an efficient business. And I think that's what, is going to be a focus across the board in 2022.
So we're talking about efficient growth. So what are the most important things revenue leaders should be thinking about, especially this year?
Revenue leaders should not purely be thinking of quota and attainment, but also the sales and marketing expenses. So one 2021 mindset is just about number of reps and how many reps can I recruit so that we can hit our number. And what they were not thinking about is all of the ancillary GTM hires that were supporting those reps, like sales enablement and sales ops and marketing ops and rev ops and all of these things and management. And those costs started to add up and balloon, and it diluted the burn multiple or the magic number. Meaning like they were spending a lot of money in go-to-market and not getting the same amount of yield that other companies or like efficient companies would be getting. So the new mindset for GTM leaders is think about both revenue, but also cost.
I totally agree with everything that Brian said there. I mean, I think, if you are a revenue leader and, you're managing an org, I think your challenge should be to be thinking about your efficiency for your entire org, not just your AE team or not just your SDR team. Like everyone supporting you like should be running efficiently. And the business, and this aligns even outside of the revenue org to product and company leadership. The product and the business and the go-to-market strategy should really be oriented around that. Like all these inputs, are efficiently creating outputs.
No, interested specifically these, like my thought is always these ancillary roles, like for example, let's say revenue enablement should actually be like a multiplicator that makes everyone a little bit better and more efficient. So is that something that, like, how does this break at scale?
That's true. You have these ancillary roles like enablement and operations that are supposed to be a force multiplier on your revenue generating headcount. However, teams, because they raised a bunch of money, they had the resources, they just started hiring all these people out of the theory of that revenue expansion or multiplication. But they kept hiring without seeing it actually manifest. So they weren't watching the impacts of those roles on increasing quotas. And that just wasn't happening. So I think that was the big miss. It's not that those roles aren't useful and they don't actually help with expanding ACVs and expanding quotas, but it's that teams were not waiting to see those impacts manifest before they continued hiring.
The pitfall that we often saw is like, okay, like, you're a small startup, you have 2 AEs, things are going really well. You're generating new ARR very efficiently. However, now you try to jump straight from 2 AEs to 8 AEs, plus 2 managers and a director and 2 SDRs and 1 sales ops and 1 sales enablement. So it's not really like the sales enablement or sales ops aren't doing their jobs well. But actually, if you do that entire jump and you go from 2 reps to 8 reps, and all of a sudden quota attainment for whatever reason, because there's not enough leads, dip down to 60%, you have so much overhead that instead of having a slightly inefficient org, because quota attainment's at 60%, things are like completely busted, right? Like this whole org is costing you, $5 for every dollar of ARR you're generating. So that's really like the pattern and the pitfall that can be fallen into.
The reason why companies scaled so quickly last year also because of the expected revenue or the target being high last year. So with everything that's happening this year and the fact that everyone's trying to grow efficiently, do you see across the portfolio companies that the revenue target or expectations grows lower but more efficiently? Is it the new kind of like mantra for this year?
It's a very difficult question because I think for businesses that want or need to fundraise again in the near future, and of course that the VCs are still going to want to see 2.5x plus year-over-year growth. Changes based on the scale. Like once you get to be in the 8 digits of ARR, then things change a little bit. But so they still want to see that, but they want to see it done efficiently, and that seems like very, very challenging. But I think maybe the reframing is that maybe all businesses were a little unhealthy in 2021, a little too big, and they just shouldn't have been that big, and they shouldn't have been growing that fast back then. I think like when I think of high level, what's happening this year is that we are all going on a diet. We're all getting a lot leaner and tighter, and we're focusing on delivering value to our customers. And then we're going to incrementally grow our GTM teams as market demand affords us those opportunities, rather than hiring based on, the last fundraising round we did and we have tons of money, so we might as well hire a zillion people.
I feel for me this sounds a little bit like this chicken and egg. Like I think the VCs are waiting to see how startups can can grow right now, and I feel like the startups the same thing. Like I can't adjust my expected growth unless I know what VCs are expecting. Because based on this, like if I want to raise another round, I need to know what they're looking for and how I can hit it. So I feel like there's like this, and I think this leads to the uncertainty where like fewer rounds are done, and at least CEOs, I believe, don't have a lot of idea right now what should the goal be.
Well, I think there's things that you can know right now, which is that everyone should be focusing on efficient growth. So, and not to get into your business, but User Gyms has always been an incredibly efficient business. But that's like a simple thing. And if to get to efficiency, it means you need to dramatically lower your growth expectations, then so be it. You have to do that. Because efficiency means you have more time to figure it out. You have more time to figure out your business model and create more value in your product to increase ACVs. But that's priority number one. And then you can afford yourself the luxury of thinking about how to increase my ARR growth multiples. Your mindset can continue to be in how do I expand my ACVs? How do I work up market? How do I increase my dollar retention? But you're right, Christian, it's a very challenging, confusing time for everyone.
I like that thinking about actually like from the sales team, and I think this is mostly based on the sales team, focused on the attainment and let the attainment drive whether you should hire new AEs in this case, like AEs or ADRs or like the rest of the sales team. I think that's a very interesting way to look at it. Like I think it's in line with the magic number you mentioned.
I think that's super important, but I think but you have to also do the math to make sure that you have the right attainment, right? So actually another pitfall that we've seen is it's actually possible to be very inefficient with like 100% attainment because you haven't actually done the math to back out. So if you start, what I recommend companies do is you basically start from a magic number of 1. And what that means is that for every dollar you spend in your sales and marketing organization, you get $1 of ARR out. It's a pretty simple ratio. It keeps you on a short payback period. If you have positive net dollar expansion, you'll have a very healthy business. with a magic number of 1. So if you work backwards from there, you can be like, okay, well, I have a sales rep, but I also have, but I'm also going to have underperforming reps and ramping reps and SDRs and management and software I have to buy. So if I kind of work backwards from all that, what does the quota have to be for my magic number to be 1? If you do that, then you can hire to attainment, and that can be super productive, and you can hire batches of AEs, and as they start to attain, like you can confidently go forward. But the only caution on doing it based on attainment is that you have to be quantitative and diligent and derive what the quota needs to be for your business.
With the focus on the efficient growth, do you see that more companies pivoting quicker or adding the PLG motion as part of the product offering to kind of offset the cost of GTM?
I have not seen that yet. I mean, all these changes have happened so suddenly that I don't, and shifting to a PLG distribution model, that is a big effort, right? That's like a many quarters endeavor. The way I think about that is like, what is your, we actually drew up this chart, Ethan and I, where on one axis you had ACV and on the other axis you had deal velocity. So you can have a low ACV if you have high deal velocity, meaning like you can turn out deals fast. That would be like a traditional PLG company. You can also have low deal velocity, like long sales cycles, but you need to have high ACVs. That's like an ABM model. And I think it's important to understand who you are, like what's your identity as a business, where do you fit along that continuum? And if there are opportunities to introduce new distribution models, like having a PLG version of your product or something like that, great. But I think there are more short-term actions that need to be focused on to improve efficiency rather than your distribution model. I think you have less control over that than people think.
I think that along these lines, like we talked a little bit about sales, but like looking at all the levers, what are things like, for example, either in sales or in marketing that I can do right now to mitigate the situation? I mean, we've heard about layoffs, but what are things that you see more outside of that, like just to be more efficient in spending or in generating revenue? Generally
speaking, and that's not that immediate, but if you're in a position where you're seeing opportunity up, so if that's at all a possible market, I would make sure that that's where you're focusing your sales and marketing efforts, because those dollars will retain better, the ACVs will be larger. I would focus on that. And then, of course, everybody's talking about how they can frame their product as a revenue generator or a cost saver, more so than they ever have. So moving from the luxury good category to the need to have category. That's kind of obvious, and everyone should be trying to do that. But I think step one is having a really keen understanding of the inputs and outputs of your business. I've been surprised at how few businesses understand their spend at that level. So the thing Ethan's built that we've deployed at Craft, SaaS Grid, very useful free tool to figure these things out and sort of observe your business in that way. But I think it all starts with knowing your current situation, and then you can diagnose what the best things to do are to improve your situation. Yeah, it just wasn't necessary to understand the situation last year, at least when it comes to spending money. Well, like I said, UserGems has always been like incredibly efficient. So you guys are sort of unique, but most businesses weren't, and raised a lot of money and spent a lot of money, and those you find yourself in a tough spot. I think another thing is there's like these stages of acceptance of this new reality, and the faster you can move through those stages of acceptance and just into positive action, the better off your business will be. It's especially true of leaders. Like leaders, another thing is to be the steady hand and the source of positivity and confidence despite a tough situation. That's very important for revenue leaders out there.
So far, like I'm kind of recapping like all the tips that revenue leaders can do today immediately. So trying to move up market where you can, trying to like watch out for like inefficient channels, trim that, think about like the efficiency in terms of like the sales reps performance. Is there any other tips or playbooks that you've seen from other companies or from your personal experience in the past as operators that maybe people are not looking at or considering that you think right now would be a good playbooks for someone to adopt?
There's obviously a lot of levers that you can pull. I think one super tactical and underutilized one is just raising quotas. Basically getting more out of the reps that you have, and it can be surprising, right? Like human psychology is complicated, but it's shocking just so much. You probably have a few reps on your team who are consistently overperforming, and if you ask everybody to move to that level and set that as a new baseline, many will, and you'll figure out the ones who can, and that can that can very quickly kind of be a force multiplier in your business. Also, and pricing is like a very similar dynamic to that, and oftentimes increasing pricing and quota goes hand in hand. But oftentimes, especially when you're in an early stage startup, pricing is such a discovery process. Your contract sizes aren't increasing just because you're not asking. And if you go in and confidently ask for that, you could do that. So just trying to do more with what you have, can oftentimes lead to surprisingly good results.
Yeah, how to increase pipeline without spending more is like $1 billion question.
Well, pipeline is a different story, right? That all kind of assumes, that either that you. It assumes that you have the pipeline, or at least you have AEs that generate their own pipeline, and that's why we really talk about this, kind of being in this bottom up or at high ACV camp, at least being in one of the two of them. If you're in both, that's heaven. That's what you're looking for. But on the high ACV side, where reps are generating their own pipeline, and you're in a large market, that can be productive. If you do have a PLG, bottom up motion, a lot of that is getting smart with like how you mine those leads for larger contracts. It's hard, especially depending on the type of tool you are. If people are signing up with Gmails, or you have like these 2 or 3 person teams signing up, being very data driven and getting really good at identifying which of those have the profile of a larger contract and getting those into your more enterprise sales cycle. Most companies that have a robust bottom-up motion have room to play with there.
I have your permission to put that slide that you mentioned, like the axis, like X and Y axis, the chart in the show notes, so if people can refer to. But just for the specific context, so what would be considered as high ACV? Because everyone has a certain definition of what is high. So what do you guys see from your end?
Well, it depends on the company. So I think it's more about the trend line than the absolute number. So at a seed stage, you can't expect to be selling 6-figure contracts. If you can, that's amazing, but that usually doesn't happen. Usually you're starting out in the single-digit thousands for an annual contract, and then you just add more product and you build more capabilities, and your customers value what you're delivering more, and you're able to serve larger customers with bigger budgets. Then you move into you go to like the 5-figure contracts, and then when you crack the 6-figure contracts, that's when I would say that's when you really are onto something big. If a company is willing to pay you $100,000 a year or more, that's a big deal. But again, I think more important is the trend line of your ACVs, and what does that look like?
I'm willing to put a number on it, and I think you can't. From my experience, if you primarily generate leads, generate pipeline through an outbound channel, mostly through SDRs, that model almost never works if ACV is less than 20K. And hopefully it is much healthier than 20K, but I can't think of any examples of really efficient, successful companies where their primary channel is outbound and they have less than 20K ACV.
Yeah, I'm glad you put the number, because whenever the moment I share this chart, this picture, people are gonna be like, "What is the number of ABM?" And so I'm glad you put the number to it and kind of like add some colors into the chart. Yeah.
And hopefully it's much better than that. I mean, to be honest, I think like even at 20K it's difficult, but I've seen it done well at 20K. I've never seen it done well, again, without bad as the motion at like 5 or 10.
Yeah, another thing, we kind of have talked about this, but just to reinforce this point, the economics of your go-to-market part of your business, one of the key points is quota and OTE for the reps. So when in boom times, when everyone was desperately trying to recruit the best reps, the reps, good AEs, had the leverage in those talent negotiations. And what would they do with that leverage? They would ask for higher OTEs at the same quota, or they would ask for higher commissions or lower variable to base compensation. That's just a normal a normal part of the talent market at the time. Now the talent market's going to be changing, so those things will change. But because those changes, you're basically, for each sale, you're contributing less dollars back to the business because more of it is going to the rep. And this isn't, I'm not saying this to be anti-rep. I'm saying this to be like purely economical about creating a startup and making it work. And these are the types of things to be observant of and sensitive to.
Just generally speaking, once again, maybe I'm just speaking from my experience, but we didn't have a good picture of the gross margin until right now, where it became urgent or like important to look at the number.
Yeah, so look, gross margins are critical for SaaS businesses, right? SaaS businesses are traditionally very high gross margins, and frankly, there's oftentimes an assumption that they're very high gross margins, which is why they get the revenue multiples that they do. But if they're not, it's a big issue. And so, if you really are a pure SaaS business and kind of the human labor that goes into your customers, aka implementation, customer support, customer success, if that's minimal, if the software does most of the work, that's not something you need to spend a bunch of time combing through. Like, you're probably in good shape. But if you see yourself doing significant hiring in customer success, in implementation, in support, if there is like a lot of labor going into making your customer success with your product, you definitely need to be measuring that and understanding what your gross margin is. Because if it slips too much, then either one, you need to find a way to correct that and spend less there, or if that's like just the reality of like what your customers need to be successful, which it is for some businesses, that means you have to be even more efficient on sales and marketing in order to make the economics of the whole business work.
My last question is about like just to understand that the burn multiple, which a lot of people talk about as well. Just for the context for the audience listening, can you guys explain like the burn multiple and what's the best way to calculate this?
Yeah, I can take that one. So, and by the way, I remember when I was running a sales team, these things were not top of mind for me. These, the sort of economics of the sales and marketing, magic number, things like that. As a venture investor, they are very top of mind. And I think now, given what's happening in the market, it should be top of mind for all leaders. And so Kraft, David Sachs wrote this sort of seminal blog about the burn multiple, which was a new kind of way of thinking about a business. The burn multiple takes the overall company burn, and so that's one number, and then the other number is how much net new ARR was generated in that same period. So how much was burnt to create $1 of revenue. And we have recently come out and said what companies should be targeting is 1.5 or 1.5 or less burn multiple. So for every dollar of new ARR, you're burning $1.5 or less. That's like a tall feat, but it is a very good metric to capture the overall health of the business. You can just see very quickly, am I spending too many dollars to generate too few dollars? Or do I have a lot of wiggle room here? Should I be spending more dollars to generate the revenue? That's kind of generate even more revenue. And so the highest level metric on efficiency, the next level down, I'd say, and Ethan, chime in if you disagree, would be the magic number. So magic number is only looking at the sales and marketing side of your business. It's sort of excluding G&A and R&D, like the product engineering and the administrative functions. And then that's looking at the efficiency of just your sales and marketing group. So it's a little bit like, let's use these metrics to diagnose the health of the business, and we'll use them to kind of point us in the direction of where there might be problems. And then we can double click on those areas and see what should be done to improve those metrics.
So go back to like the formula you mentioned. So like the new ARR that generated for the calculation of the burn multiple, does it include the renewal as well? Like on the point of renewal, is it considered as new ARR, or is it like this is net new business ARR?
No, it's not just net new. It's your total increase in ARR, right? So just take the end of your ending ARR in June minus your ending ARR from May. So it's everything that you add from new business and expansion and upsell. So like the net sum of like everything you do, both with your prospects and your customers, divided by how much you burned in that same period. And so because it's how much you should burn, it should be right? If you have if you have a magic number, of 1, that basically mean that your sales and marketing team has a burn multiple of 0, right? Because assuming that your customers are paying you upfront, right? Like if you spend $100,000 generating $100,000 of ARR, you get that $100,000 immediately. And so basically, you've like broken even on your sales and marketing org. And now all the R&D and overhead, right now you basically have 1.5x whatever that ARR figure was you could spend on that and still overall be a very efficient business.
You have a solid magic number, but you have a bad burn multiple, it means you're overspending in product engineering or the administrative functions. And maybe overspending is not the right word, but it's you are choosing to invest a lot in R&D, and sometimes that's the right choice depending upon what stage of business you're at, and sometimes it's not. But in either case, these are, just think of these metrics as tools to observe the health of your business and kind of instruct you on changes that should be made.
Brian, let me be a little more specific there, though. For companies that find themselves in that case, most likely they actually have low gross margins, and that's what's pulling down the burn multiple. It's most likely the people that are getting, heads that are getting added in customer support and customer success and implementation. It is true, there can be a very high investment in product and engineering, but obviously that has good long-term dividends, and frankly, at least to date, the hiring market has, I think, prevented most early stage startups from overspending in that department.
I think I want to highlight what Brian told me in this case, where the goal of investing in product and engineering is ultimately getting a higher ACV. And I think that's really the right way to think about this. I mean, ultimately there's a timeline to this, but it needs to, ultimately you need to see that the ACV increases there. And I think the other thing that I'm hearing a lot of numbers here, and I think as a sales and marketing leader, it's really the first time where we need to stop. We already have some numbers in our dashboard, but really looking at what are we missing in order to make actually the right decisions in this environment. So I think the one big thing that I've heard across here is maybe so far we didn't track the right numbers, and we need to really think about, do we have all the numbers under control?
If you have a problem, don't get despondent. There's two other things to keep in mind. One is it's coming to an end. It just means that you need to improve it. If you believe in what you're building, which you probably do if you're working there, then it's a function. If you have bad metrics, it means improvements need to be made. A mindset of affecting positive change rather than negativity, because that will infect your team and it'll just end up poorly.
Mm-hmm. Absolutely. No, I love that now all of these metrics at the business level become so transparent, where revenue leaders can actually take a look at it besides just a revenue target and then the budget that each department has. I feel like this is kind of getting all the teams to look at the same set of number, maybe using SaaS Grid and kind of see the dashboard of how healthy the business is. And that will also help company align all their teams, not just within the revenue team. Thank you so much for staying over, guys. This has been really, really awesome.
Thank you very much. It was fun to chat with you guys. This is a topic that we care a lot about.
Yeah, thanks, guys.